All right, folks. I know it's been quite a bit of time since the last time I actually made a video for everybody, but I thought this one here was very important for me to initiate the year with more videos. And I wanted to do something quite quick. I want to address something that's alarming a lot of folks, consumers, realtors, loan offices out there that didn't quite understand the difference in what's happening now on May 1st. Okay. I have put together a slideshow here for you. My team did, and I'm reusing it for everybody here. I'm bringing this information back to the consumer, realtors, and loan associates that of mine. And of course, as everybody know, I'm all about information and kind of making sure that you understand where it's going out there. But I'm going to put up here. This is, I promise, going to be a real quick presentation. I know some of my presentation takes an hour, but now this one here is going to be quite quick. Okay, so we're going to go straight in. I don't have any guests on the show today. This is straight up a presentation for you. It's going to go on my channel on YouTube. You can share with all the friends and all the associates of yours and everything else. Okay, let me go ahead and share the screen. Boom, 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 boom. Here you go. Share. So now you should be seeing the big question that is out there. Okay. What we're going to be talking about is this question right here. Are mortgage for better credit borrowers costing more starting May 1st? In other words, if you have better credit, you're going to see a higher cost for having better credit. And those that have the worst credit or not below fair credit or fair credit, will they get a discount better than the ones? Does it pay for you to be doing bad? It's what I've seen, the questions out there, and a lot of podcasters and a lot of people talking about it because they're just looking at the news. Okay, so let's look at this next highlight here, and I'm going to try to answer this question for you here very quickly. Okay, let's go to our next slide. It allows me. Okay, Biden rule. This is being called the Biden rule. Biden rule will tax home buyers with good credit to lower costs for those with bad credit. Is that true or false? Well, that is false, guys. False. And we're going to get there. You know, we're seeing a lot of these. I mean, you guys are already aware of this. You know, media doesn't quite, they're fear mongers. They're really pushing a narrative. They're politicizing every mood. Of course, this is a political movement here by the Biden administration. That's for sure. But we need to get down to the truth to understand what's really happening out there because this is causing folks to get a little bit scared of purchasing a house, right? They're thinking what they're doing to us. It's going to cost me more just because I have better credit. What is that? What's going on? Okay, so let's go look at the other one. So we determined that this is not true, guys. Do not believe everything you see out there. Okay, next one. All right, next one. Home buyers with good credit to pay higher mortgage rates. Not true either. Not true either. What we're seeing out there is where they're closing in the gap of your cost to borrow a loan. Okay. Let's go to the next one right here. All right. Biden raises cost for home buyers with good credit to help risky borrowers. That's sort of true. This one here is actually sort of true. Um, you know, better credit or decent credit borrowers are slightly paying more, and then riskier borrowers are slightly paying less. Okay, so but again, we are trying. What they're trying to do is close. I'm not doing anything. I don't make the rules, right? And of course, I must state that this is my opinion of what's happening out there, and everything I see here is I'm exercising my First Amendment rights, right? To explain to you guys right now. So, anyways, so this is not it's true in some degree, so that you understand. I don't want to make this thing a huge storm which we're seeing out there, buyers and buyers agents and everybody getting concerned with what's going on and calling us in high volume just to find out what's really going on there. So I thought I'm going to bring this out to you guys, consumers, and everybody that's in my sphere of influence, my platform, to know a little bit better what's going on. Okay, so let's go to the next one here real quick. Okay, mortgages for home buyers with good credit to cost more starting May 1st. High risky buyers will pay less. That's sort of true. That's sort of true. And in the next slide here, I'm going to show you. What I see. Okay, so a lot of you guys don't understand what you're looking at right now, and I get it. I'm going to quickly explain it for you. This is a table called matrix or a table of adjustments. Okay, everybody gets the same rates, guys. You qualify for a loan. Everybody gets the same rates. Okay, this new legislation does not change the guidelines of borrowing a loan for anybody. All right, it does not change the guidelines. You're required the same thing for everybody. Okay, so what you're looking here is the old way, the one that has not it's still available today before the new one takes effect May 1st. Okay, so what you're looking at here is, and you see here LLPA, that stands for loan level price adjustment. Okay, so let's take a look at it right here in this bracket so you understand. LTV is loan to value. Basically, just so you understand, if you see 97% right there, it means that the borrower put 3% down. If you see 85 to 90, let's call this one here 10% down payment, okay? And it kind of shows you what adjustments to cost. Everybody, again, I repeat, everybody gets the same rate. However, the cost of the loan is a little bit different for everybody today in regards to their credit score. As you can see here, there is a huge gap from someone that has a decent credit score, 740, against somebody that doesn't. It has a 620. That's a 3% gap. So meaning that if you are borrowing $400,000, that person with decent credit score right now currently pays about $1,000 in cost, in loan cost. And then the person with 620 is paying 3%, close to $11,000 in cost for them to obtain this loan. But the same rate, guys, the same rate. So what's happening here today is that what they're looking to do here is to close the gap, make it so that it doesn't seem like we're discriminating somebody that has lower credit score. Okay, so right now, like I said, if you're putting 10% down payment, someone with 740 is paying about $1,000 in cost, and somebody with 620 is paying about 11,000. So yes, there is a huge gap there in cost, and I understand the concept. What this was, the ones with lower credit score, they represent a higher risk. They're riskier borrowers, so therefore they get their money up front. Just make sure before they default, basically, that sort of thing. Being truthful, be straightforward with you. You know who I am. But anyways, let's go to the next slide. And this here is going to show you the cost difference after May 1st. Okay, remember the previous slide is what we have today. And this next slide right here represents the new cost adjustments, okay? All right, so look at this. This is quite interesting. What we're seeing here is that somebody with a decent credit, 740 or more, is in that same bracket right here, or let's say 15% down payment right here. Is where there is the highest adjustment, okay? Where this change has impacted the most. It's right over here on the red. Everything else on green took the least amount of adjustments, okay? So right over here, what they did is, at 740, they increased your cost by 3/4. So now you have a full point. So now it's $4,000 cost. Okay. And then what you're seeing over here on 740, they discounted the higher risk borrowers, 740 score to 644, and that same 15% down payment, they now discounted 3/4. Okay, so they essentially discounted about $4,000 for the riskier borrower. But what they did actually was to close the gap in between the decent credit score and the lower credit score to make it as more fair as possible. But notice something pretty interesting that one of our teammates who prepared this, helped us with this slide over here. I can tell you this. I don't think she's a teammate or she's an associate of ours. This is quite interesting, guys. But if you look at it over here on 95 to 97, in fact, if you put less down payment and you're in a higher score bracket, the adjustment became favorable to you. So almost like they're now promoting higher interest, less riskier credit scores or more desirable credit scores. If you put less down payment, you are now getting a discount. It's better than what used to be or that it is current. Okay, so beginning May 1st, less down payment means a better cost for higher credit scores. So you see the biggest adjustment really was here within 15%. And one of my remarks in this particular situation here is that what I'm seeing is it's almost like these lenders and these legislators are promoting you to stay within the bracket where you pay mortgage insurance, because if you don't know yet, you put less than 20% down payment, you're going to incur mortgage insurance, right? So this year, they're kind of incentivizing you that have the better credit score to put in less down payment, have mortgage insurance, but you get a discount. But again, if you ask me, do you agree with what's done? Of course I agree. Of course, this, in some degree, there's got to be a difference between somebody with a better credit score, less risk, and it's got to be a higher cost for somebody that has a riskier credit history. Okay, it just makes more sense. It's just like when you go lease a house. Sometimes when you don't have good credit score, you don't have a strong application, then sometimes they collect 2 months, 3 months, 4 months, 5 months security deposit just to protect themselves. Let's say your rental history, it's shoddy. You had a couple of months in your previous rental that you missed a payment here and there. You know what I mean? I'm just gonna try to be I'm the landlord. I'm gonna try to be as safe as possible. Maybe this person it's gonna have the same problem this time. You just never know. So it's all about minimizing risk. Okay. But at the moment here, this is not as alarming as the media was trying to make it look like. Okay. So you need to understand the adjustments a little bit better so that you understand that this is not an interest rate adjustment. Riskier borrowers are not getting a better interest rate. What's happening here is they are closing in the gap. They're making it so the cost of somebody with desirable credit score and not so desirable credit score, the cost is closer to one another. Okay, not these huge differences that we were seeing currently. Anyways, so a couple of questions to consider here is, does this affect all loans? No, it does not affect all loans. It only affects conventional loans, not government loans, okay? Is this heading us back towards the crash and situation of 2008? No, not even close. That's not the case here. Everybody's thinking 0% loans, or everybody's thinking we're going to start lending money to riskier borrowers like we used to. No guidelines have changed. Everything else to qualify is the same. What happened in 2008 was a completely different story, which we can get to in another time. You can, however, consider calling me and discussing this in person with me. I'm always available for anybody here local in Houston. Anywhere in the country. If you want my assistance with anything, just reach out. If I don't answer, leave a message. I do not return calls without voice messages, and texts are always better for me to know who you are first before I reach back. But again, I hope this was helpful for you to understand what's out there. What we learned is that you should not always believe everything you hear from social media and the media out there. Okay. I think you need to educate yourself a little bit further. Call a professional. Call myself. My number is 832-980-5627. Let me unshare the screen here so I can look at you. Call a professional to discuss your future home purchases, whether this is the right time for you or not. To quote your interest rates, to find out what the cost is. Do not rely on social media and media. Call your local professional that can answer all these questions for you. And it's always good to get more than just one opinion. Get two, get three opinions. Figure it out on your own what is the best path for you to take. Well, thank you so much for this opportunity. I'll see you again on the next video.